Good morning, everyone. My name is Cameron Byrne. I'm the General Manager of Partnerships and Memberships here at the AFA. I would like to introduce you to today's webinar, the Adviser As Nostradamus, brought to you in partnership with TAL. Standard 6 of the FASEA Code of Ethics requires advisors to consider the broad effects of their advice. Does this impose superhuman qualities on the advisor to predict the client's future with accuracy and tailor the advice accordingly? What happens to advisors whose predictions prove to be incorrect? Today's webinar outlines the course and scope of Standard 6 of the FASEA Code of Ethics and scope of this standard, and dispels the hysteria surrounding dire predictions of multiple statements of advice for family members and the unpleasant consequences for advisors who fail to predict future outcomes with pinpoint accuracy. I would like to introduce you today to our presenters, Scott Hogar and David Glenn, National Technical Managers at TAL. Scott has over 20 years of industry experience. Beginning his professional career at a young age, Scott has built up a sound financial planning knowledge base, focusing on contemporary insurance advice. In 2011, Scott founded his own financial planning business with his wife, specialising in personal and business insurance, where he provided his retail clients with cutting-edge personal and business insurance advice before making the move to join TAL. His primary responsibility is providing strategic risk advice to all financial advisors and licensees. David's responsible for providing advice on the tax treatment of TAL products. He also leads the development and delivery of technical content for advisors. With over 20 years experience providing tax and strategic advice to the financial services industry in Australia and Asia, David is well equipped to work closely with advisors to formulate effective client solutions. David has worked as a tax partner at a large accounting firm and more recently was tax counsel for several insurance companies. David is a qualified solicitor, chartered accountant, and holds a postgraduate diploma in taxation law. Before we begin, I'd just like to cover off some webinar housekeeping. Today's webinar has one CPD point available in professionalism and ethics, and we'll send out the details of this within the next week. We will answer questions throughout this presentation. So please use the Zoom Q&A feature, not the chat function, as you can see on the diagram on the slide. Thank you for joining us today. I'll now hand over to Scott and David.
Thank you, Cameron, for the introduction. You can tell that David's far more qualified and better than me when reading through his list of accomplishments. But DJ, I think with ethics, sometimes maybe being a lawyer might hold you back. So I'll do the first part of today's presentation, and you can do the back end.
Okay, let's go.
We've got a disclaimer on the screen. Obviously, the information contained in today's presentation is of a general nature, and of course, we're talking about the Code of Ethics. So, unbelievably, ethics is kind of on a spectrum. So, what I believe is ethical may be very different to what you believe is ethical. And certainly the way that we go through this presentation and highlight some of the key impacts of the code, again, you may disagree or you may agree with what we bring out in terms of content. So really importantly, this is the sort of session that is good to listen to, but of course you'll form your own opinion as to how you might apply this moving forward. And with the code, of course, your interpretation is key, because ultimately you are responsible yourselves for your interpretation of how the code is to work in practice. In terms of learning outcomes, you can see on the screen here, we're going to go through the scope and scale of Standard 6 of the code. We'll go through how scoped and scaled advice may play a part in light of Standard 6, because obviously, scoping and scaling is really important from the advice process perspective, but there's a link to Standard 6 because obviously the advice that you give and the subject matter that you provide will be impacted directly by Standard 6, whereas the subject matter you do not provide advice on but is relevant to the client is not likely to be impacted by Standard 6 because you haven't given advice on it. So that's a really, really important one. Determine what might be considered relevant for broad effects and likely circumstances, and David will give a few examples of this, and provide practical tips to including qualitative questions in terms of assisting you with Standard 6 compliance. And I think before we sort of kick off with the main part of the content, we haven't really seen the impact of Standard 6 really at this stage, because we haven't seen much enforcement in terms of the code. And, we recently did with the AFA on their roadshow, of course, a presentation on ethics. And Phil did mention that we haven't really seen or learnt much in respect to self-reporting of breaches of the code. So all we're talking about today is what we predict might happen now that ASIC and the FSCP have control of the monitoring of the code. But of course, we haven't really got any existing cases that we can talk through to demonstrate because we just haven't been told of any. So again, it's sort of our version of predicting the future for Standard 6 in terms of what it might mean for advisors. We'll go through a bit of an introduction. We'll look at the concept of an informed position, and that's an informed position of the advisor. We'll go through appropriate scaling of advice before David will move into broader long-term interest and likely future circumstances, which are the sorts of things that you need to consider as part of the standard. So let's start with a bit of an intro. The point around Standard 6 is that's a really broad standard in terms of its application in practice. You must take into account the broad effects arising from the client acting on your advice and actively consider the client's broader long-term interests and likely future circumstances. Now, look, that's probably something that advisors have been doing for quite a while anyway, since the introduction of best interest back in 2013. All advice, really, with the exception of perhaps general advice or client instruction advice, instruction-only advice. We've been doing this anyway, but this is really focusing our view on what we should be doing with clients more than, say, corporations law ever did. The application of this standard is reliant on the appropriate scoping of relevant subject matter that's in the client's best interest. Now, that's the really important part of this particular presentation, in that you can really only apply Standard 6 once you've done the right job in terms of scoping and scaling. And scoping and scaling is done differently across licensees and across the industry. But I think most are doing a reasonable job in terms of identifying relevant subject matter. It's just what they do with that relevant subject matter post that identification that needs to be perhaps considered in light of Standard 6. And the important part about today's particular session is that the advisor does not need to be Nostradamus, but you must consider reasonably foreseeable events from an informed position. So what would a reasonable financial advisor foresee for the client sitting in front of them? And an example, before we get to it, I know we talk about it in a bit more detail a little bit later, is if you fund your insurance premium through superannuation, then it is reasonably foreseeable that that will impact your retirement savings. So that is something that Standard 6 would obviously play a part in, because we're looking at this long-term likely future impacts, and that is something that you would consider reasonably foreseeable. Another example might be if you recommend a life insurance policy, it is reasonably foreseeable that the client will die with the policy in force. Now, it's not likely to happen, obviously, but for a qualified, reasonable financial advisor, that's something that clearly needs to be considered. And we do know of an AFCA case that involves a situation where the estate planning component of the advice wasn't completed and the advisor was taken to AFCA. So really importantly, we're looking at reasonably foreseeable. Now, we can't foresee everything. We couldn't have foreseen COVID. Certainly the stock market crash that we're going through right now, or the performance being not as good as we'd hoped, is something that we could foresee, because of course investment markets are cyclical. But really importantly, we're not including things that you couldn't possibly have seen or foreseen in terms of the advice. And that's what a reasonable financial advisor would conclude. Now, the intent of Standard 6 is to ensure that before giving advice, financial advisors have determined whether or not the advice is consistent with this client's long-term interests and likely future circumstances. And that's where, as we mentioned before, this whole idea of insurance being funded through superannuation, which is to meet an immediate need, perhaps at the detriment of a longer term need, needs to be considered more. And that's where your documentation is going to be key. The focus areas of this particular standard, it really obviously requires financial advisors to actively consider the broader long-term interests and likely future circumstances. And that's really not just from the advice that you provide, but also the documentation that you provide the client as well. Because what you're trying to demonstrate to anybody who's asking is that you have considered these long-term interests and likely future circumstances in your advice document and in your file notes. Now, you need to come at this from an informed position on the client's relevant circumstances, which does require, obviously, a decent view of the client through the fact find, and we'll talk about that a little bit later. The appropriate scaling of advice, which I've mentioned. So that is firstly the identification of relevant subject matter, and then the apportioning of that subject matter between what you're going to give advice on and what you're not. And we need to have a look at a consideration of the broader long-term interests and likely future circumstances within the scope of advice that's provided. Now, that's really important. And I mentioned it a little bit earlier, which is you can't be obliged to think of standard 6 in relevant subject matter of advice that you're not going to give. Because really, this is an active long-term position that you're going to take with the client from today's initial advice all the way through the client's life cycle with you, the financial advisor. So it's not fair for a code to impose the requirement to consider long-term interest on advice that you're not going to give. However, in the case of, and again, it's the easiest example, in the case of, say, insurance through superannuation, although you may not be the advisor giving advice on the super, so, the fund, the investments, the fees, all that sort of stuff, because you're giving advice on insurance that links to that directly, you can't ignore the impact of the erosion through standard 6. So when you give the initial advice, you'll be talking about it. And as you go through that life cycle with the client, you'll also be talking about the fact that you are robbing Peter to pay Paul, which needs to be dealt with over time. And so we're not saying in this scenario here that you'd have to give advice on the fund the client has in terms of super. It's just the impact of the insurance within that particular fund. Now, you could argue that this standard reflects the existing best interest obligations under 961B, but of course it's not identical. And the code is interpretive, as is unfortunately corporations law to a degree. So you'll have to make your own view in terms of how you're going to apply that. But we think advisors have been doing this pretty well for quite a while anyway. So it's just about tinkering at the edges in terms of compliance with standard 6. And as I've said, we don't really have much in the way of advice from FASEA, the predecessor monitoring body, or ASIC at this stage. And, we don't know when we'll get any feedback from them in terms of how they're going to apply the standards in the code. So we need to come at this from an informed position. So the first thing that we need to do regarding this particular standard is look at the client's circumstances. And the first point to note here is that financial advisors have an ethical duty to look more widely at what the client's circumstances are or the client's interests are. So what we're saying here is that although the client may have a predefined reason for coming in to seek advice, it could be insurance or superannuation or whatever it might be, an inheritance, your job as a financial advisor is to act as a general practitioner up front. So, you are diagnosing effectively the client's needs, irrespective of whether the client has brought them up themselves. So really what we're saying here is that at the beginning, you are just trying to work out exactly what the client might need from a financial advisor. And to determine the scope of advice, you must have an understanding of what the client's goals and objectives might be. So they will tell you explicitly what some of them will be, but your job as a financial advisor is to uncover the needs the clients didn't know they had. And I was reading an article this morning on a case study from a claim, and the advisor was talking to the client. The client wanted advice around self-managed super fund, investments, those sorts of things. But the advisor said, look, the foundation to any good financial plan is to have good insurance. Now, the client didn't specifically ask for it, but it was an outcome of this diagnosis process, the scoping of advice. You're uncovering needs the clients didn't know they had. And to be fair, most clients don't really know what they need or what they want, especially when it comes to insurance. Certainly in my practice, I found that most clients didn't know what critical illness was, even income protection. They had a vague idea, but not really an understanding as to how it works. So your job is to identify not just what the client explicitly seeks out, but also help them work out what those other areas might be. Now, you don't have to give advice in those areas. You don't have to give advice in, for example, superannuation or wealth if you're not a wealth advisor, but uncovering the needs really important. And I think in the regulatory guides from ASIC, they do provide some good examples of this where the advisor is picking up relevant subject matter outside of their speciality. And that's the key part here. Now, determining what these client goals and objectives might be does require complete and accurate information. So there is a corresponding requirement in corporations law through safe harbour for you to make sure that you're working with complete and accurate information. But of course, they do give you an out in corporations law by saying if you make reasonable attempts to obtain the information and the client's still not forthcoming, you can provide advice, but you'd need to provide a warning to say the advice is based on incomplete or inaccurate information. You probably don't have that warning in the code, because the code says, look, you need to make an ethical decision as to whether or not the information that you've got is enough for you to proceed. So a quick example might be the client says, I've got no money. I've got poor affordability. I know I need insurance, but I can't afford it. So the advisor recommends cover through super, comes from accumulation, but the client refuses on file to give access to or provide information on financials. So they give you the headline figures of what they're earning, but they don't give you the expenses. Now, through corporations law, you'd make reasonable attempts to gather the information. The client's still not forthcoming, you'd provide the warning. In the code, you've got to make an ethical decision as to whether or not you can give advice. Now, I think you can, David. If you're there online right now, you might be internet shopping. I'm not sure. No, he's there. That's good. I think in this situation, I would give advice, but I would give advice only after getting some more background from the client around, their discretionary spend and, is their money saved at the end of every fortnight, week, whatever it might be. What do you think in this relation, in this ethical dilemma?
Yeah, I agree. What you've got to do is you've got to get that complete picture. If the client, for whatever reason, doesn't give you that complete picture, you've then got to look at alternatives to get that picture. And if at the end of the day you can't construct the picture that's adequate for the giving of advice, which is an essential foundation, you've then got to make that hard decision. And the position I would take in that situation is this is the major difference between the code and corporations law. Corporations law will allow you to proceed and give the appropriate health warning. My view would be that the code, as the ethical overlay, doesn't give you that luxury. You're probably going to have to decline to act in that situation. But as Scott said, that's ethics is not something that's black and white. You're going to have to make a call. And what I urge people to do is, when you make an ethical call, think about the situation 2 years down the track. What does your situation actually look like? Or what will it look like 3 years down the track? Can you justify your position 3 years down the track? If you can, then maybe you can proceed, but always look at the position in the cold, hard light of subsequent events. Over to you, Scott.
Thanks, AG. So you can see here that David's far more ethical than I am, because I would give the advice in that case, and again, I'd gather more information, but it just goes to show that it's about your interpretation. But I think this is something that advisors would face on a regular basis in the risk space. So therefore, you'd want to make sure that when you are faced with this ethical decision, ethical dilemma, that you do document how you've proceeded and justify your position. A question here: does ethics play a role in how insurance calculations are used to determine life, TPD, IP, and trauma? Absolutely. And I think, Phil Anderson was one of the very first people to talk about Standard 3, which is conflicts of interest, and the code and how they might play a role. Because if you think about insurance commissions are conflicted in a sense that the more that you write, the more you get paid. But of course, you avoid that conflict of interest by having an appropriate methodology to determine an appropriate level of life, IP, TPD, and trauma. And what you're really saying to the client here is, because I've got this methodology in place, because I've got this philosophy, we make sure that you only walk away with as much insurance as you need, and therefore that removes that particular conflict. In terms of how that's calculated in terms of life, TPD, IP, and trauma moving forward, it's certainly a long-term play here when it relates to Standard 6. So, as the client moves through their life cycle, from when they first see you as a client to having kids and getting mortgages and all that sort of stuff, a constant review needs to be considered, because obviously things will change. And therefore, ethics does play a role both under Standard 6, because it is reasonably foreseeable that things will change, and Standard 2, which is best interest. So hopefully that answers that question. If it hasn't answered that question, just feel free to follow up a question in the Q&A and I'll be happy to answer. Question before I do move on, the methodology and calculators can be sometimes significantly different. Absolutely, they can be. And that's the thing about individualized personal advice and individual personalized advisors who have their own view of the world in terms of calculation methodology. So you have to be able to stand up hand on heart and say, this is the best way I know how to do it, and have some proof points as to why you're doing it. So for example, if you're saying that you need to replace an income to a spouse, then that calculation methodology needs to be transparent. If you're using insurance to fund a spouse income, for example, so the main income earner passes away, you've got the lump sum payable to the spouse, then you will have considered other options available to you other than using an insurance policy. For example, the client's spouse returning to work. So all these things will happen, and that proves to the client effectively that you're acting ethically, that your behavior is demonstrating that ethical lens. So hopefully, again, that does answer that question. So Cameron, you can tick those two off. Unless there's further questions, please feel free to put them in the Q&A. All right. The last point I'll note here is that financial advisors are not relieved of this ethical duty. So it's an ethical duty to look more widely, merely because the client does not provide enough information even when asked. And that's a really interesting one, I think. And I think we probably haven't seen what this looks like from an enforcement perspective just yet. And what I mean by that is what they're saying here really is that if the client gives you the wrong information or not enough information for the advice area you're looking to give advice in, it's kind of not on them. It's on you, the advisor, because you are the professional. You hold all the power in the relationship. You have all the skills. So an example of that might be, let's say you say to the client, what is your income? And the client is self-employed and the client says, look, my income is $100,000. And so, you put that in the fact find, and as a consequence of that, an IP policy is put in place for, $100,000 or 70% of in the new world. And then when it comes to claim time, we learn that that $70,000, $80,000, $100,000, that we insured the client for at 70% was incorrect, because the client was talking about dividends from a previous year or drawings or distributions or some other form of income that is an appropriation of income rather than income from a personal exertion perspective. And all of a sudden the claim falls apart. Now, the code there says, well, you as the professional should have been able to make sure that the client's information was correct. Now, that seems harsh, and it's very different to, say, lawyers, but that's what they mean by this ethical duty, which is, the client kind of gets off scot-free and the advisor is faced with a dilemma. So really importantly, there are going to be certain concepts you're going to need to make sure that you've got proof points on before you give the advice, especially when it's intrinsically linked, like income and income protection advice. The information that you gather must be sufficient rather than comprehensive. That's actually both in corporations law and in the code around the way that you scope advice. So you must be able to identify relevant subject matter, and therefore your fact find must contain sufficient information on a broad subject of matter. So you're going to be able to make sure that when you do that fact find up front, when you're talking to the client, you can identify what that subject matter might be. You can ask some really good questions to help narrow down the subject matter relevant to the client. And look, you're doing that on a daily basis. Anyway, we've done quite a few sessions on this with advisors, and of course, they're giving us some really good questions that are being asked in the advice process. Now, you are not required to complete a holistic fact find for scaled advice. However, as I mentioned, it must be sufficient enough for you to be able to identify what we call relevant subject matter. And only after you've identified the relevant subject matter for the client can you give advice to that client or scaled advice to that client sufficient enough to be in an informed position. So only after going through this general practitioner process, which is the identification of all that relevant subject matter, gathering the information required, can you then scale your advice to give the advice in the areas the client is looking for or the areas in which you're authorised to give advice. So I think it's a really important process to have this part done well, because this appropriate scaling of advice is going to be really key to the application of many of the standards you find in the Code of Ethics. And that's when we'll now move into appropriate scaling of advice. So the first point to note is that scaled advice must be in the client's best interest. So that is an obvious statement, I think, but they do mention this quite a few times within the code, talking about the fact that you do need to make sure that any scaled advice or any provision of scaled advice must be in that client's best interest. Now, both the corporations law and the code do allow for the provision of scaled advice. And remember, when you do give scaled advice, that can be at the request of the client, or it can be scaled by the advisor, because the advisor might not be authorised or competent in certain areas, and they shouldn't be obliged to give advice in areas they're not authorised to give advice in. That makes perfect sense. What they do say is that limited scope engagements or scaled advice can be really highly effective in delivering appropriate advice to clients, but you take this independent professional assessment as to whether or not scoping is in the client's best interest. And there's going to be examples, and they have provided examples, where the client excludes something to their detriment, which means that the advisor cannot give advice in the space they're after because of the exclusion of other relevant subject matter. Now, scoping does require the advisor, as mentioned, to consider all of the subject matter identified by that advisor in the engagement. And then you'll determine this by what we call explicit subject matter and implicit. Now, explicit subject matter is what the client says, I want insurance, I want wealth, I want an SMSF, whatever it might be. Implicit is what the client doesn't ask for, but would be appropriate to include because of what they're asking for, because of their circumstances, because of whatever it might be. The advisor, a reasonable financial advisor, concludes, yes, that is going to be relevant for the client sitting in front of me. So that's the challenging part of the advice process, is around, well, what would be considered reasonable in terms of relevant subject matter in relation to client circumstances. So we have an example here. It's Michael, who is a new client referred by a third party. Michael's just bought his first home in Perth and is considering life insurance. Michael has average financial literacy. And obviously, financial literacy is an important part of the code under Standard 5. And like many Australians, feels 10 foot tall and bulletproof when it comes to his health. He sees the need for cover, but doesn't value the product. And I think that's probably fair of a lot of clients with a lot of products, which is, they don't necessarily see the value, but they know they've got to have it. Things like insurance is one, private health insurance is another. Even wills, clients know they need it, they just haven't got around to getting the job done. He has heard from a colleague of his that you can simply run cover through superannuation and therefore not have to pay for the premium himself. He tells you, my objective is life insurance cover without having to pay for it directly. What is the explicit subject matter sought by Michael? So look, I think when we've done this straw poll with advisors, most will say the explicit subject matter in this particular case study would be insurance. So insurance is in, and whether it's all insurances or just life insurance will depend on the advisor. Some say it will be life insurance and superannuation because although the client hasn't asked for advice explicitly on super, they've included it as part of their insurance recommendation. So it sort of is linked that way and would be explicit. But of course, even if you can't determine that it's superannuation, for example, would be explicit, it will come up under implicit. So what could the implicit subject matter be in this particular case study? Well, the first one here is estate planning. And we know that insurance and superannuation advice are intrinsically linked to estate planning because there is an outcome that needs to be considered. So as I mentioned earlier with that AFCA case, the client unfortunately did pass away and there wasn't any nomination of beneficiary, and that's caused problems. Now, it's reasonably foreseeable that that would have happened, and it is linked as implicit subject matter to the advice that you give. Now, the client hasn't said in that particular statement on this previous slide, give me good estate planning advice. It's just an outcome of life insurance and superannuation. Taxation advice would also be considered implicit because both the funding of the premium and the payment of the claim has a taxation outcome. So if we have a look very quickly at the funding of the premium, now if they fund the premium through the accumulation funds that the client already has, which we've already discussed, there's still a transaction we have to consider, and the transaction in this case is going to be the trustee of the superannuation fund the client's a member of paying a premium on the member's behalf, and that premium is going to be deductible in this particular case because it's life insurance. TPD, because in the new world post-regulation 407D, we're talking any occupation only, in superannuation, that's also deductible to that particular trustee if that client was to take it out. And of course, we know about income protection. The other part is the claim, and that's where the estate planning link comes in, where we need to know where the money needs to end up, because of course that may attract a tax outcome. Now, in most cases, the good news is the money will go through to a CIS and tax dependent, and therefore we're not going to have to worry about taxation on lump sums. But of course, if it doesn't go that way, or there's no nomination, or trustee gets discretion, that could cause problems. So, tax is a part of the advice, although the client hasn't asked for tax. Cash flow is obviously really important. The client's got cash flow issues, they've told you. They don't want to fund the premium. There are issues with that. Cash flow may be something that the client would value, not a financial product, but still something the client might value in terms of relevant subject matter. So it needs to be considered. Now, one quick note here is that if you're giving cash flow advice, typically you wouldn't be providing an SOA in corporations law, because cash flow advice, you're not providing advice on a financial product. However, under the Code of Ethics, and you can look at some of the examples they provided, that would typically need to come up in a statement of advice, although it's not a financial product. So there's a bit of a difference between corpus law and the code, but because that corporations law kind of has, the code has precedence, then you're probably going to need to do a statement of advice for that. And lastly, retirement savings, again, this is the superannuation aspect of it. So paying the premiums via the client's accumulated balance clearly is going to have an impact on their retirement savings. So that's going to be implicit. Now, we don't think you need to give advice on the product itself if you're not authorised or wanting to, but there are impacts you need to consider. The super environment's different. The policy is held by the trustee of the fund, not the member. The claims process works differently. And of course, there's the erosion of retirement savings over the long term. And if you think about some of these clients who hold money in superannuation right now when the market's starting to drop, they may be having to sell down assets because they haven't got enough in their cash account, for example, to fund an insurance premium, which means they're selling in poor market times, which means that could be quite detrimental to that particular client, especially when you've got unitized funds. So here's a bit of a scaled advice process map. So a bit of a process to go through to get to the provision of scaled advice. So determine relevant subject matter, have this two-way conversation with the client on needs and priorities. You scope what is in the best interest of the client, and you scope out with analysis. And what we mean in relation by analysis is if you are determining relevant subject matter, so you have all of the relevant subject matter in the middle, you scope in what you're going to talk about over here. So we're talking about insurance in this case here. On the other side, we scope out the relevant subject matter that we're not giving advice on, and we provide an analysis. Who scoped it out and why was it scoped out? Because you don't want a situation in the future where the client says, well, you should have spoken to me about this at the time. I wasn't aware of X. I wasn't aware of Y. I've suffered detriment now, and that's part of the process fault. You're a fault because you didn't go through it. So that analysis is really important to say, if you don't do this or you don't seek advice in this area, then this is the impact, and here's the detriment you may suffer, and away we go. So the client then can't come back on the advisor and say you should have done something, when of course, and really, clients suffer amnesia when things go wrong because they always say, yes, this happened, or no, it didn't happen, when of course the opposite did happen in actuality. So not all financial advisors are holistic, and not all clients seek holistic advice, and that's fine. Both in the corporations law and the code. It's just the process you undertake needs to be considered. And the best way I can sort of view this very quickly is if I was a patient going in to a doctor, and let's say I was going to the doctor because I had a cough, cold, flu, and I walked in and I had, a really gnarly looking mole on my face that didn't look too good. That doctor would talk to me about my cold and flu, but they would likely bring up that gnarly looking mole on my face because they've got a duty of care to do so. And that's kind of what financial advisors do in financial advice. They have this duty of care to identify relevant subject matter for the client and do something with it. Now, that doctor who is a GP isn't a specialist in skincare, doesn't have to give me advice on my cancerous mole, but they will refer me. And that's kind of what the expectation is of a financial advisor, to say, we don't do this particular type of work here at XYZ Financial. However, you benefit from it, we can refer you out. And that's, I think, a really important consideration. So it is an ethical consideration. And if the client does require advice in areas outside of the financial advisor's speciality, and that, as I mentioned before, could be via authority, competence, business structure, they need to determine whether they can provide advice in that client's best interest. So it's a bit of a challenge, a bit like scoping, and it does require the use of an ethical lens. And as we've discussed, ethics is a bit of a spectrum. Each client circumstance will be unique. And so really, when you do apply an analysis on your dilemma, you'll ultimately come up with a unique position for most clients. And it is important to get scoping right, is because when you apply standard 6 moving forward, and remember, the code hasn't been around long. So when we're talking about the code moving forward, and an example would be those death benefits or erosion of superannuation, you can only apply that standard on what is subject matter that is scoped in. So we've spoken about that client with the poor cash flow, minimal superannuation. What can we do? So again, I think you need to make sure that you have your notes on file about how you approach the provision of scaled advice. And remember, much of advice is scaled because clients don't take everything. What I'll do now is I'll hand you over to David Glenn, and David's going to go through the broader long-term interests and likely future circumstances. David, if you want to get your screen going.
Yes, certainly. Bear with us while we get the technology working. Right, so what we're going to consider here are the broader long-term interests and likely future circumstances. Scott has spoken in terms of what we do at the point of scoping and scaling the assignment. Let's consider the position now going forward from that particular point. So the Code of Ethics guide that was issued in October 2020 emphasizes that financial advisors must consider long-term interests and future circumstances when determining the scope of the advice that is going to be provided. So you very much have to be standard 6 aware at that point of the scoping and scaling of advice. And Scott spoke extensively as to the process that should be undertaken at that point in the assignment. Now, let's say there's certain matters that have been scoped out, and you've outlined in the scoping of the assignment how these matters are going to be dealt with. For example, the client might be taking specialist legal advice on a particular issue. It would be impractical to then say that in regard to those excluded matters that you then start having to apply standard 6. So if a matter is excluded from the scope and dealt with appropriately, you then don't have to apply standard 6 to that excluded matter and determine the long-term impacts of that excluded matter. That would not be inherently unfair on the advisor. But let's consider now the approach that you need to take post scoping and scaling of the assignment to standard 6. So firstly, the standard doesn't require you to provide advice to anyone but the client. So there's a lot of hysteria when standard 6 came to light, that everyone regarded standard 6 as requiring the advisor to provide advice and statements of advice to all family members. That is not a correct view of standard 6. When you apply standard 6, you have your client, you provide advice to that client, and you consider the long-term impact of that advice on the client. Now, what that means, of course, is very important to establish the identity of the client. And whenever you are dealing with ethics situations, it's not only a standard 6 situation, you really have to take a step back and ask yourself, who is the client? Now, the reason why this is important is very often you'll be confronted with complex family structures, and there'll be corporate entities in that family structure, discretionary trusts, partnerships, etc. And you have to then make call as to who the client is in that particular situation and to whom you are actually directing that advice. So what that means, I think, is that you have to really get a complete picture of the family, of the client's family situation, of the client's business situation. If the client is an SME operator, so that you can establish the identity of all these associated entities, and then you can consider the impact of your advice on the associated entities. So if, for example, you're giving advice to your client in the client's capacity as a member of the SMSF, you're not giving advice to the trustee of the SMSF, which might be a separate corporate entity. But what you need to do is you need to consider the impact of your advice on this corporate trustee when you deliver the advice to the client. So it's very important at the time of assembling the SOA, you need to make sure that you are aware of all the associated entities, and then you advise the identified client and cover in your advice to the identified client on any impact to associated entities. Now, the best approach, I think, to take in all ethical matters, and this one is no different, is that you should err on the side of conservatism, so that if you are confronted with a particular borderline situation, the best way, I think, of dealing with a borderline situation is to err on the conservative side. And in this case, erring on the conservative side means that you would cover the impact on that particular entity in your SOA. So let's look at Standard 6 in practice. You're now delivering the advice in your identified area. You've scoped and scaled the advice appropriately. What do you actually need to consider practically in the areas covered by the particular advice as far as Standard 6 is concerned? Now, the first area is time. So think of your advice on a timeline. You need to consider the impact of the client, the impact of the advice on the client over the short term, over the medium term, and the long term. So think firstly in terms of a timeline and how your advice is going to impact the client across the timeline. The next area that you need to consider is the impact on the client and their family. So you consider firstly the impact of the advice obviously on the client, but then on various family members. And this becomes particularly important in an insurance context because there are going to be consequences in the event of a claim under the insurance policy concerned. So you need to then consider how are the claim proceeds going to flow in terms of that policy, and who is actually going to be impacted if there is a claim under the policy. There may be winners and losers, and of course, that needs to be brought to the client's attention in order to comply with Standard 6. The third area is the whole area of cost, premium cost. Think of insurance as basically transferring the risk from the client to the insurer, and there is a cost associated with that particular risk transfer. And what we need to do is we need to make sure that the client is fully aware of that cost. And again, we need to not only look at the impact of the premium in year one, but the impact of the premium in years 2 moving forward over the estimated life of the risk transfer arrangement. So, for example, if you're dealing with an income protection policy for a client who's age 50, you would probably need to consider the impact of those premiums payable over the next 15 years. So you'd assume the client is withdrawing from the workforce at age 65, and the client would be paying premiums roughly until age 65. And fortunately, many quote systems offered by various companies do give you a view of what the likely premium increases are going to be. So what the client needs, therefore, is a complete picture of the cost of the arrangement going forward. Now, there are other considerations as well. Firstly, the estate planning consideration. Ultimately, the rubber hits the road when a claim is made under the policy, when there's death of the life insured, who actually gets those claim proceeds, and is that an appropriate outcome for the client from the perspective of tax, from the perspective of legal risk, and from the perspective of regulatory risk. When you are dealing with superannuation, regulatory risk is particularly important, so you need to consider the impact of regulatory risk over the life of the policy. So what your advice should therefore include is who's going to be the nominated beneficiary under the particular policy in superannuation, and whether or not this is valid under the SIS regulations. So, for example, if the intention of the client is to nominate a sibling, that would generally not be compliant with the SIS regulations. And of course, if you're taking into account your standard 6 obligations, you would need to warn the client of the dangers with that particular course of action. Similarly, taxation is a very important issue when you're considering the tax impact of the arrangement, because you've got to look at the tax impact of the arrangement over the long term. And a good example of that would be a TPD policy that's taken within superannuation. TPD policies within superannuation are of course very cost effective, because you're using the tax deductibility created by the superannuation system in order to reduce the cost of the premiums. But of course, the consequence for the client is a tax liability, and the client needs to be fully informed of that. And an appropriate response in that case for somebody discharging their obligations under Standard 6 would be to recommend that the amount covered would be grossed up to take into account this tax exposure. And certainly this is the expectation of ASIC when you're dealing with TPD inside insurance, and this grossing up exercise is recommended strongly by ASIC in its statement 413. So let's deal with some specific examples now. And the first example we're going to look at is looking at Standard 6 in terms of time. So in this particular situation, the client has a high risk appetite and is cost conscious. So the advisor is recommending an income protection contract with a 5-year benefit period. So clearly, this particular contract is much more cost effective than an age 65 benefit period, but of course, it does leave the client exposed beyond that 5-year period. And of course, the client will be living with the consequences of this advice until withdrawal from the workforce, generally at age 65. Now, that's not to say that you default automatically to an age 65 benefit period, because clearly the major cost of income protection cover is this benefit to age 65, and the probabilities of the client requiring that benefit are extremely low. So very often a 5-year period may be appropriate to the client's circumstances, taking into account the client's risk appetite and the client's financial circumstances. So when you're applying Standard 6 to that particular situation, think in terms of, what does this look like in the short term? Well, short term is not a problem in a sense, because the risk transfer will operate for a 5-year period. But then once you go into the medium term, you are then talking about a client self-insuring for the balance of the risk. Now, there's not an issue with self-insurance in itself. Self-insurance can be a particularly appropriate risk management mechanism in certain circumstances. What the client needs to do is firstly self-insure from the point of view of an informed choice, and then you would explore with the client alternative ways of dealing with the additional risk exposure that is created. And one of course, the alternatives would be to see whether or not you can stopgap this particular exposure with a TPD policy. And then, of course, you look at this point on the long term, and the long-term situation is that the client may find themselves in that situation of needing cover to age 65, and the client may well be particularly adverse to risk, and in those circumstances maybe a 5-year benefit period is not appropriate for that client on account of the client's perception of the risk. So this gives you, I think, an example of how Standard 6 would apply when you're looking at that advice over the timeline that I was talking about. The next area that you need to consider when you are looking at Standard 6 is, of course, the impact of your advice, both on the client and the persons associated with the client. So let's consider this particular situation. You've got a 55-year-old client with a life insurance policy in superannuation. This client has no spouse and 2 economically independent adult children, and the client is estranged from 1 child and has executed a binding death benefit nomination in favor of the 2nd child. So in this particular situation, the family is going to be living with the consequences of this particular advice. And the important point to note about death cover and beneficiary nominations is that you don't have the opportunity to rectify any mistakes after death. So we have to ensure that the process follows seamlessly, and we need to ensure that the client is fully aware of the consequences. So what we need to do is we need to consider the impact on child 1 and the impact on child 2. So child 1 is excluded, so you still need to consider the impact on child 1. Child 1 is not going to get any benefit, but what is the risk associated with the family over here? And of course, the risk is that there's going to be a lengthy dispute over the death claim proceeds, and what needs to happen here is that the client needs to take appropriate legal advice in terms of that particular risk. Child 2 gets 100% of the benefit. That's maybe all well and good for child 2, but does child 2 have the financial responsibility in order to take the benefit on those terms? Is it not maybe more appropriate for the benefit to flow to child 2 in the form of an income stream? So we must make sure that we look for Standard 6 purposes at all risks to the deceased estate associated with the particular insurance policy. That doesn't mean that you've actually got to provide advice on an outcome of a contest of an estate, but what it does mean is that you need to alert the client to that particular risk and then show the client how that risk should be dealt with. And of course, generally speaking, the risk of an estate being contested should be dealt with by the client taking appropriate legal advice. If we now look at the next example, and the next example deals with the application of Standard 6 in relation to premium cost. So what we have in this particular situation is a client with poor cash flow. and the advisor recommends a life policy in super funded by the client's balance in superannuation. So short term, the client's got no cash flow strain, and that's obviously of benefit to the client. But in the medium term, there is the erosion of retirement savings. And in order to discharge our standard 6 obligations here, we need to alert the client to the 2 elements of erosion of retirement savings. So there are 2 elements here. One is the actual premium itself eroding the balance, and then there is also the prejudice to the earnings of the superannuation fund as a result of the balance being diminished. And if we look at the long term, we have the impact of compounding interest and detriment to the client's superannuation balance. So it is very important in this particular situation to make sure that we look at erosion over the long term, so that we incorporate this compounding effect, because standard 6 requires us to do just that. If we look at another situation involving premium costs, you've got a client who's got an insurance policy outside superannuation in this particular case, and the recommendation here is to switch the policy. If the policy is going to be switched to another company, it's still going to be catered for outside superannuation, so that we don't have the complexity of inside or outside superannuation in this particular example. But we still have to deal with standard 6, even though this might at first blush seem like a fairly simple exercise. So the recommended policy that is going to be switched, the new policy carries a premium saving. But what we need to do in order to discharge the obligations under standard 6 is again to look at the premium flows under both policies. So we need a comparison of premium flows under both policies over the short, medium, and long term. And particularly, does this ostensibly lower premium cost for the new insurance company? Is this possibly just a honeymoon saving? And at the end of the day, there's going to be some clawback of that honeymoon saving, in which case it might not be to the client's benefit to actually switch the policy. So a switching exercise needs to be looked over, needs to be examined over the short, medium, and long term. So remember, insurance and super are intrinsically linked to estate planning. You've inevitably got taxation issues, and you look at tax, I think, in 2 ways with insurance. One is the tax situation at the funding stage, and the other is the tax situation in the event of a claim. Cash flows are very important. Always map cash flows and determine the impact of those cash flows from a tax, legal, and regulatory perspective. Retirement savings are vital here. We're doing more than 50% of insurance in superannuation these days. And what this means is that we need to consider the impact on retirement savings. And by definition, you're looking at this on a long-term basis, because you're looking to ensure that the client's quality of life post retirement is not compromised in any way. That brings to a conclusion this presentation. Before I hand over to Cameron, I'd just like to alert you to the benefit of ethics courses that are available through the Risk Academy, the TAL Risk Academy. I urge you to take advantage of these courses, particularly if you are in need of ethics points. Remember, ethics CPD points, you need 9 ethics CPD points per annum. So this could be a useful way of achieving that. Over to you, Cameron.
Yeah, thanks very much, David, and thanks to Scott for earlier piece in the presentation. On behalf of the members and the AFA, we'd like to thank both David and Scott for their presentation today. Today's webinar recording will be available on our website. So if you want to have another look at it, or someone's missed it and you want to send it on to them, please do so. Registrants will receive an email confirming this when available, and the CPD, a couple of questions that have come through CPD certificates, they'll be sent out to you within the next week. So on behalf of the AFA and our members, thank you to Scott and David for your time today and the valuable content, and also to Tal for being a key partner of the AFA. So thank you very much and have a great afternoon. Thank you.
Thank you very much for listening to us. It's been great presenting.